Hey, very good afternoon to you traders. Mark here from Daytrading Room. Sunday afternoon. Hope you all had a great trading week last week. Let's get straight to it. Okay, a couple of questions to run through. First of all, one question which I thought was a really great observation, and I like this sort of thing, people thinking about different ways and different approaches. Dan emailed me a while ago and I have replied to him directly, but I'll share it with you guys. He's using the prior day's VWAP as a place to initiate a counter trend trade. So in other words, let's say on the Thursday here, let's get the drawing pen out. On the Thursday here, there's the close of the VWAP, so it's the prior day's VWAP, and if the price on Friday came down and touched that, you'd look to initiate a trade there for a counter trend push back up. It's not something I use, but to me, I like that a lot because it makes perfect sense. If you put yourself in the shoes of someone who's executing a basket of trades or an algorithm that's been ordered to execute a basket of contracts, should I say, over a 2-day period, then they're not going to reset the VWAP on this day. If they started here executing, they're going to be using the VWAP all throughout the day as their benchmark. Let's say they're looking to buy, so anywhere underneath the VWAP they're going to be more aggressive on these sort of levels. As it pops above it, they're going to back off a bit and see what happens the next day. But then as the next day opens, the VWAP is going to be here for them, excluding the overnight session, of course. It's not going to be here because the first hour or so, or a few hours, the VWAP is obviously has far less meaning because there's less trade and volume gone through. So an algorithm or a trader executing over a 2-day period, for example, is going to be using that as a benchmark. So if the price starts to get back down here, he's going to be far more active as the price approaches it or goes below it, because he's beating his benchmark. He's allowing to bring his average lower than his benchmark average that he's using. So I think that's a great idea. It's something that's worth looking at, and if it works for you, then that's fantastic. And I think, as I've always said, is if it makes sense to you and you've got your risk managed with the strategy, then anything can work. So good stuff. That's a really good thing. The other question was, and this is something that I wanted to talk about a while ago, but I got distracted and I think I did a video on something else. But this is a very key part of day trading, intraday trading, that I think is often overlooked, and sometimes you can slip into doing it differently. Okay, let's use an example here. Okay, look at this Wednesday. This is Wednesday here. YM we're using just an example. And let's say you're looking to fade, especially at the moment when we have mean reversion type markets. We do have a few trend days, obviously, but if we're looking to fade key levels, it's a mean reversion type trade, looking for a move back into a mean, whether you're using a moving average, a VWAP, a gap, whatever it may be. That's mean reversion, looking for extensions to pull back to a mean. So let's say, for argument's sake, you're looking to fade the prior day's highs, looking to fade that level here. So you've marked it on before the day starts, and there's plenty of reasons why you wouldn't want to do this in the real world, because it's a trend day and blah blah blah, but let's just use it for an example for now. Now the question is, how do we fade that level? Now you've got a couple of options. Now number one, your first option is that you leave a resting order there, and you've got a stop in, and you let it get filled, and you get your stop wherever the stop may be, and you hope that you're not going to get pinged, and then it's going to roll back under, and it's going to be able to cover it in the lows or whatever it may be. Now the problem you've got with that is that you don't know how aggressive the market is. Your stop is, you're using a stop based on previous data. So how quickly does the market run through that? The market could, running through 20 ticks on a slow day is probably almost a breakout, but running through 20 ticks when you're on a real volatile day is just noise. So if you're using a 15 tick stop, then it's too wide, and it's not necessary on a very slow day, because you can probably tighten that right up. But then on a wilder day, or if it's some sort of news has hit it as we're approaching that level, then it's going to be just noise. So it's difficult to regulate where do you come out of the trade when you're doing that. So that's one of the disadvantages of that. And secondly, you're just using it as a single marker. You're saying, okay, I'm assuming that's a prior day's high, that's going to stop there. Now one different way of doing it, and a way that I prefer generally under these sort of quieter conditions, is to wait for a subsequent test. because once the level has proved itself already, then you've got opportunity to take the trade again after the level has shown that people are there and waiting to sell it at that level. And also you can then adjust your stop a little bit more accurately and perhaps tighten it up or loosen it if as required, so that you're actually the stop is based on the premise of the trade as opposed to an arbitrary figure. So this example here, the market pushed through, whatever that is, 15 ticks or so, 17 ticks, push back under. This is a 5-minute chart, by the way. Push back up again, failed. That's the point that I would then be looking to take the trade. Now the problem with doing it this way, of course, is that if you only get one test, i.e. this is number one test here, and it rolls back over, you've missed your trade. You've been waiting for it and you've missed it. So that is the disadvantage of waiting for number two. But the advantage, of course, is that having seen where the high has been, you can then use your stop, put your stop in a more structured position, and then you've got a sort of a zone to work off. You've got the prior day's high here and that high there, where you can start to initiate a trade and perhaps look at your tape to try and fine tune when the buyers are running out of puff, when the tape's just running and it's not moving any further, and just try and really tweak the entry in that way. So there's your advantages and disadvantages. There's no right or wrong way of doing it, but that's just perhaps two ways of looking at it. If you're a little bit more cautious and you want to maybe tighten that risk up a little bit, but you're prepared to watch trades go without you, tag your level and never get another look, then the second way of doing it, waiting for that second test, is probably a better approach. If you're happy to take on a bit more risk, but you want to be involved on all of the touches, because some of the very best trades just kiss a level and never look back. Some of the very best trades would do that, go up, kiss, and then just fall through the floor. You never get that second look that you can get on board. So it's a toss-up between the two. You have to decide what's very best for you as a trader. As I say, there's no right or wrong. I'm a great advocate of that, of trading, but just another way of looking at it. If you've got a key level, let's just make sure it is key. Let the market test it first. Prove if it just rips straight through, then you can scrub that one off, and maybe you can be looking to buy a pullback to it again as opposed to fading it. If it struggles, then creeps back up and struggles again, maybe that's the time to have your mean reversion trade. So that's just one way of approaching mean reversion strategies. Okay, finally, very, very quickly, let's talk about the markets. Crude oil is well worth watching at the moment, guys. There's loads of stuff going on obviously in the world with Iraq and what have you. And crude oil has been very, very quiet for a long, long time. Back in 2008, it was an absolute beast, and it was great to trade. This period here, 2008, was just a glorious, glorious trading environment. We haven't had that for a while. I'm not saying we're going to get that, but the point is with commodities is the different people involved in it, and there's a forced hand very often. If you're a refiner, if you're a consumer, if you're a producer of crude oil, often you have to buy or you have to sell. You have no choice. If your business model is revolved around selling crude or buying crude, you can't just stop your business. You have to either pay up for it or you have to sell it. It's very different to the indices where you're purchasing, or stocks where you're actually purchasing a piece of paper that gives you the right a percentage of a company on a piece of paper. A physical commodity, especially like crude, there's a lot more motivated buyers or sellers. So when it's in play, it is really in play. So it's starting to get there now. We're not talking about crazy volatility, but just this geopolitical risk, just the supply demand imbalance coming through, waking up a few more speculators and traders, hedgers as well. People who have maybe been a bit lazy about their hedging, all of a sudden thinking, oh, I might have to put some hedges on here, or maybe people who have got a lot of crude in storage, thinking the prices are good here now to sell it. It just sort of starts to wake more market participants up. So it's well worth watching. We're coming up to some pretty decent levels. Obviously, Brent's the one that's affected more, but US crude, the West Texas Intermediate, the CL futures contract is affected similarly, but not quite as much. So whichever one you choose, whichever one you're comfortable with, and I think there's opportunities in both. So well worth watching. I'm definitely much more focused on this now, especially as with what's going on in the world. So it's worth watching. And that's pretty much what I've got for you today, guys. Hope you're managing the risk well. Markets seem to be reasonably quiet still, with little bursts of volatility in between. Um, Again, it's just focusing on keeping the risk managed. If you are playing the mean reversion, being cautious about where you're initiating a trade, getting in rhythm with the new, get a feel for the new rhythm of the day, the volume, and just trying to avoid the chop, because chop doesn't help anybody. So just let those retail guys just stretch themselves out a bit, let them chase things, breakouts, and then when it runs out of puff, there's your mean reversion trade. Similarly, if we do suddenly get a range extension and everyone's still mean reverting, let that get painful, let them cover on the pullback, and then maybe look for the second leg. That's the sort of thing that I'm looking at. Well, I would be looking at. I'm not watching the markets as actively at the moment. There's summer calmness, but that's generally how I would approach things in this environment. So keep risk managed. Take care. Back in another video shortly.